Listen up. I don't care if gold just hit $4,400 an ounce. I don't care if your uncle's neighbor doubled his money on silver. You know what I care about? Not watching you lose your shirt chasing a market that's screaming warning signs louder than a fire alarm in a paper factory. Kevin O'Leary has built $1 billion empire by reading cold, hard data, and right now that data is flashing red on precious metals. You think you're diversifying? You're gambling? You think you're protecting wealth? You're exposing yourself to 5 catastrophic risks that could obliterate your portfolio faster than you can say market correction. But before I tell you exactly what these risks are, you need to understand why everyone telling you to buy gold right now might be leading you into the biggest trap of the decade. Let's get something straight right out of the gate. I'm not some gold bug conspiracy theorist living in a bunker with silver bars. I'm a businessman. I look at assets the same way I look at companies on Shark Tank. Show me the numbers, show me the return, show me the risk-adjusted opportunity cost. And right now, when I look at precious metals heading into 2026, I see a party that's gone on way too long and nobody wants to admit the music's about to stop. Here's what everybody's talking about. Gold prices surged past $4,000 per ounce in 2025. Silver more than doubled from its 2023 lows, blasting past $70. Investment banks like Goldman Sachs are predicting $5,000 gold. JP Morgan says $5,500 by Q4 2026. Retail investors are piling in. Your neighbors buying gold coins. YouTube channels are screaming about $100 silver. Everyone's acting like this train has no brakes. But here's what Kevin O'Leary actually says about gold. He calls it a wealth stabilizer, but listen carefully to his language. He invests in historical and numismatic gold coins. That's collectibles. That's not the same as betting your retirement account on spot gold prices or silver futures. He's playing a completely different game than the retail investor buying bullion at a premium, thinking they're the next Warren Buffett. And speaking of Warren Buffett, you know what he said about gold? It's just about the last thing he'd want to own. He'd much prefer acres of land, an apartment building, or a candy company over precious metal. Why? Because those assets produce income. They generate cash flow. Gold sits there. It doesn't build factories. It doesn't hire employees. It doesn't create value. It just sits in a vault costing you storage fees and opportunity cost while you pray someone else will pay more for it later. That's the fundamental problem. And the risks we're about to discuss make that problem exponentially worse. So let me walk you through the 5 signals Kevin O'Leary would be screaming about if you walked into the Shark Tank asking for money to invest in precious metals. Risk signal number 1, the Federal Reserve reversal trap. And this one's a killer. Here's what everyone thinks is happening. The Fed cut interest rates. Lower rates mean lower opportunity cost for holding non-yielding assets like gold. Therefore, gold goes up. That's the narrative. That's what every precious metals dealer is telling you. That's why investment banks are bullish. But here's what they're not telling you. The Fed just signaled it's done cutting. In December 2025, the Federal Reserve made its final rate cut and then basically said we're not going aggressive into 2026. They're watching inflation. They're watching employment. And if inflation stays sticky or ticks back up, guess what happens? Rates stay higher for longer. Or worse, they reverse course. Now pay attention because this is where it gets dangerous. Gold's entire 2025 rally was built on the expectation of continuous rate cuts. The market priced in 75 basis points of cuts. Some models had 120 basis points. That expectation drove investment demand. That drove the ETF inflows. That pushed prices to records. But expectations and reality are 2 very different things. What happens when reality doesn't match expectations? The trade unwinds, fast, violently, without mercy. We've seen this movie before. Every time the Fed pivots hawkish, precious metals get crushed, not gently, not gradually. They fall off a cliff because leveraged traders scramble for exits and retail investors panic. Goldman Sachs put out a note saying structurally high central bank demand and cyclical support from Fed rate cuts will lift gold to $4,900 by December 2026. But read between the lines. That entire thesis depends on the Fed cutting rates. If the Fed doesn't cut, that thesis evaporates. And what's left? A metal trading at all-time highs with no fundamental support and a lot of retail bag holders wondering what happened. Let me give you the cold, hard numbers. When the Fed raised rates aggressively in 2022, gold dropped from $2,070 in March to $1,630 by November. That's a 21% crash. Silver got destroyed even worse, falling 35% peak to trough. And that was when gold wasn't sitting at $4,400. It was already lower. The higher you climb, the harder you fall. Kevin O'Leary would look at this setup and ask one simple question: what's my downside? If the Fed stays hawkish and real yields rise, gold could easily correct 20 to 30%. That's not a prediction. That's historical probability. From $4,400, a 30% correction puts you at $3,080. Are you willing to stomach that loss? Because the people buying gold today at record highs sure aren't prepared for it. And here's the kicker: the opportunity cost. While you're sitting in gold praying rates come down, equity markets could be ripping higher on strong corporate earnings. Dividend-paying stocks could be throwing off 4 or 5% yields. Real estate investment trusts could be generating cash flow, but you're in gold, generating zero. Hoping sentiment doesn't shift. That's not investing, that's speculation. And when Kevin O'Leary looks at speculation versus risk-adjusted returns, he walks away. Every single time. So ask yourself this question: are you investing based on what the Fed might do, or are you gambling based on what you hope the Fed will do? Because if it's the latter, you're not an investor, you're a speculator sitting at a very expensive poker table where the house is the Federal Reserve and they hold all the cards. And right now, they're telling you they're done dealing. That's risk signal number one. And we've got 4 more that are just as dangerous. Risk signal number 2, the crypto competition catastrophe. Now, I know what you're thinking. Crypto and gold aren't competitors. Gold's been around 5,000 years. Bitcoin's been around 15. They serve different purposes. Wrong. Dead wrong. And if you believe that narrative, you're about to get crushed. Here's what's actually happening in the market. The younger generation, the millennials, Gen Z, they're not buying gold, they're buying Bitcoin, they're buying Ethereum, they're buying digital assets. And when I say younger generation, I'm talking about the people who will inherit trillions of dollars over the next 20 years, the people who will be making investment decisions for the next 4 decades. And they don't want gold bars sitting in a vault. They want digital assets they can move with a phone tap. Let me give you the numbers that should terrify you if you're long precious metals. Bitcoin's market cap is approaching $3 trillion. Gold's market cap is around $15 trillion. But here's the critical data point. JP Morgan released research suggesting Bitcoin could challenge $28.3 trillion of gold's institutional money. That's not all of gold's market cap. That's the institutional allocation. The stuff that really matters. And if even 20% of that flows from gold into crypto, you're looking at massive selling pressure on precious metals. Now you might say Bitcoin crashed this year. It underperformed. It's down from highs. Exactly. Which is why 2026 could be the year it rebounds. VanEck, a major asset manager, just predicted Bitcoin will be the top performer in 2026 after getting crushed in 2025 compared to gold and the NASDAQ. They're forecasting a strong comeback. And where do you think that money comes from? It comes from people rotating out of last year's winners. And last year's winner was gold. Think about the psychology. Retail investors chase performance. They buy what went up. In 2025, they bought gold because it hit records. In 2026, if Bitcoin starts ripping higher and gold stagnates or corrects, where does the money flow? Back into crypto. It's predictable. It's human nature. It's exactly what Kevin O'Leary would anticipate. And here's what makes this even more dangerous for precious metals. Institutional adoption of crypto is accelerating. We're not talking about retail gamblers anymore. We're talking about pension funds, endowments, sovereign wealth funds. Grayscale just released their 2026 outlook, calling it the dawn of the institutional era for digital assets. They expect rising valuations across all 6 crypto sectors. They think Bitcoin could exceed its previous high in the first half of 2026. If they're right, and institutional money starts flowing into crypto infrastructure, into Bitcoin ETFs, into blockchain technology, that's capital that would have traditionally gone into gold as a diversification play. The pie isn't getting bigger, the slices are just getting redistributed, and gold's slice is about to get a whole lot smaller. Kevin O'Leary understands portfolio allocation, he understands capital flows, and he understands that when a new asset class emerges that serves the same psychological purpose as an old asset class but offers better technology, better liquidity, and better adoption among younger investors, the old asset class gets disrupted. It doesn't disappear overnight, but it bleeds, slowly, painfully, permanently. That's risk signal number 2. And trust me, the next 3 are even worse. Risk signal number 3, the industrial demand illusion. And this one specifically destroys the silver bulls. Here's the pitch you've heard 1,000 times. Silver isn't just a monetary metal. It's an industrial metal. It's used in solar panels, electronics, electric vehicles, 5G infrastructure. Demand is exploding, supply is constrained. We're headed for a massive deficit. Silver's going to $100, maybe $200. Sounds great, right? Until you actually look at what happens to industrial metals during economic slowdowns. Then the whole thesis falls apart like wet cardboard. Let me give you the data everyone's ignoring. Silver benefited from strong industrial and investment demand in 2025. That's past tense. But heading into 2026, analysts at ING are warning that the primary risk to silver comes from the industrial side. Specifically, a sharper than expected economic slowdown. And guess what's brewing? Recession risk. The Fed's keeping rates higher for longer. Consumer spending is slowing. Manufacturing indexes are weak. Europe's economy is struggling. China's growth is below expectations. These aren't conspiracy theories. These are published economic indicators. And when the economy slows, what happens to industrial demand? It collapses. Heraeus Precious Metals just released their 2026 forecast. You know what they said about silver? They expect prices to remain volatile with likely struggling demand in certain areas. Their forecast range is $43 to $62 per ounce. That's a 44% spread. You know what that tells you? Uncertainty, massive uncertainty. And uncertainty in commodity markets means volatility, and volatility means risk. Here's the part that should scare you. If industrial demand slows and real yields rise, silver doesn't just stabilize, it retreats. Hard. One analyst at CBS News put it bluntly, silver could stabilize or retreat from current price levels if industrial demand slows. That's code for we're at a top and there's nowhere to go but down. Now let me hit you with the worst case scenario. Silver breaks $70. Everyone's euphoric. Retail investors pile in thinking they're catching the next big move, then economic data weakens, GDP disappoints, corporate earnings miss, manufacturing contracts, industrial buyers pull back, and suddenly the narrative flips from shortage to surplus, from moon to doom, and silver doesn't fall gently, it crashes. Because that's what industrial commodities do during recessions. You want to know what Kevin O'Leary would say if you pitched him a silver investment based on industrial demand? He'd ask you one question. What happens to your thesis if we hit a recession in late 2026? And when you stammer and make excuses, he'd lean forward and say, that's exactly why I'm out. Because smart investors don't bet on perfect conditions. They prepare for worst-case scenarios. And the worst-case scenario for silver in 2026 is devastating. Risk signal number 4, the volatility massacre. Let's talk about what volatility actually means for your wealth. Because when precious metals dealers say silver has high potential for big gains, what they're really saying is buckle up because this thing could swing 30% in either direction and destroy your mental health in the process. CBS News ran an expert analysis on silver heading into 2026. Their exact words, silver has high potential for big gains in 2026, but with that potential comes an increased risk of volatility. That's not bullish. That's a warning label. That's like saying this medication might cure you or might give you a heart attack. Good luck. Let me show you what volatility looks like in real numbers. Mike McGlone from Bloomberg Intelligence just released his outlook for 2026. He's predicting extreme volatility where gold could hit both $5,000 and $3,500 in the same year. That's a 43% swing on gold, the supposedly stable safe haven asset. If gold can swing 43%, what do you think silver does? It doubles that. We're talking potential moves of 60, 70, 80% up or down. Now, here's the psychological reality nobody talks about. You're not going to time the top, you're not going to time the bottom. You're a retail investor watching numbers on a screen, trying to figure out if this dip is a buying opportunity or the start of a collapse. And while you're frozen with fear or greed, the algorithms and institutional traders are eating your lunch. Kevin O'Leary built his wealth on predictable cash-flowing businesses, royalty companies, dividend stocks, businesses with earnings you can model. You know why? Because volatility is the enemy of wealth preservation. When your asset swings 40%, you're not investing, you're riding a roller coaster, and roller coasters are fun at amusement parks. They're devastating in retirement accounts. Here's what happens in real life. You buy gold at $4,400 because everyone says it's going to $5,000. It drops to $4,000. You panic sell. Then it rebounds to $4,800 and you feel like an idiot. So you buy back in at $4,800. Then it crashes to $3,500. Now you're down 27% and emotionally destroyed. That's not wealth building. That's wealth destruction. And volatility is the weapon. Risk signal number 5, the opportunity cost killer. And this is the one Kevin O'Leary would hammer harder than anything else. Opportunity cost is the return you give up by choosing one investment over another. It's the silent wealth destroyer. And right now, the opportunity cost of holding precious metals heading into 2026 is absolutely crushing. Let me paint the picture. You put $100,000 into gold at $4,400 per ounce today. Gold goes to $5,500 over the next 12 months like JP Morgan predicts. Congratulations, you made 25%. That's $25,000. Sounds great until you realize what else you could have done with that capital. What if you put that $100,000 into an S&P 500 index fund? Historical average return is 10%, but we're in a bull market driven by artificial intelligence, productivity gains, and corporate buybacks. What if the S&P returns 20%? You just matched gold with way less volatility. What if it returns 30% like it did in several recent years? You just crushed gold and you didn't have to worry about storage, insurance, or liquidity issues, but it gets worse. What if you put that $100,000 into dividend aristocrat stocks yielding 4%? You're generating $4,000 a year in passive income every single year. Whether the stock price goes up or down, you're getting paid. Gold pays you nothing. Zero. Zilch. You're praying for price appreciation while dividend stocks are paying you to wait. Let's go even further. What if you invested in businesses Kevin O'Leary actually recommends? Royalty companies in the energy sector, software companies with recurring revenue, businesses with pricing power and margin expansion. These companies can double or triple in value while throwing off cash flow. Gold just sits there hoping fear stays high. And here's the part that should keep you up at night. We're potentially entering the greatest wealth creation period in human history. Artificial intelligence is about to transform every industry: robotics, biotech, renewable energy, space exploration. Trillions of dollars in value creation are coming, and you're going to sit on the sidelines holding metal because you're scared of inflation? Kevin O'Leary didn't become a billionaire by being scared. He became a billionaire by calculating risk-adjusted returns and allocating capital to opportunities with the highest probability of success. And right now, with gold at all-time highs, silver extended, volatility increasing, Fed policy uncertain, and economic growth questionable, precious metals are nowhere near the highest probability success. The opportunity cost isn't just financial, it's psychological. Every day you hold gold at these levels is a day you're not participating in the markets and sectors that are actually creating wealth. That's not preservation, that's stagnation. And stagnation is the enemy of wealth building. That's risk signal number 5. And now you've got all 5. So what do you do with this information? Here's exactly what Kevin O'Leary would tell you. If you already own precious metals, set a stop loss. Decide right now what percentage loss you're willing to take and stick to it. Don't let emotion override discipline. If you're thinking about buying precious metals at these levels, don't. Wait for a correction. Wait for better entry points. Wait for the Fed to actually cut rates instead of hoping they will. Focus your capital on cash-flowing assets, dividend stocks, real estate, businesses with earnings. assets that pay you while you wait instead of costing you opportunity cost. Diversification doesn't mean buying everything. It means allocating capital intelligently across assets with different risk profiles and return drivers. And most importantly, stop listening to people who profit from selling you gold. Listen to people who profit from being right. Kevin O'Leary's built a billion-dollar empire on cold, hard data and risk management. That's the model. That's the standard. Now go execute.